And I'm going to give you a quick tour of Chubb, and then I'm going to open up my valuation and kind of update all the analysis. So Chubb is a fairly big market cap. Its market cap is 109 billion, revenue of 54 billion. This is an insurance company, and it's an insurance company with a variety of products in a variety of countries. Its PE is a very low 12. Isn't that awesome looking PE? We're in the land of PEs are 30 to 60 in technology, and these guys are at 12. Very nice. Analysts believe it's a buy, and it's discounted by 6.5%. They pay a small dividend of 1.34%. They announced today, so we're going to look at their earnings in a bit. All right, so looking at that, over the past year, this stock is up 12%, close to 13 with that dividend. Let's call it 14%. Not bad, not bad at all. And it's up 81% over the 5-year. Not bad at all. You add those, the dividend, maybe you're close to high 80s, like 88, 89. Of course, Warren Buffett owns Chubb. As soon as Warren Buffett owns a stock, right, it gains a lot of credibility. It certainly does in my mind. All right, so Chubb announced. Let's go straight to the earnings announcement and see what they said. So it's CB, Investor Relations. Let's hear it from the horse's mouth and see what earnings were issued out. And then I can update my valuation on the fly. You can see my process here. Fourth quarter 2024 press release. Let's take a look. Make this a little bigger so your guys can see it. All right. So news release, Chubb reports fourth quarter per share net income and core operating income of $6.33 and $6.02 respectively. That's GAAP, non-GAAP. All right. And I'm going to kind of speed read, try to get to the meat of the announcement. Okay. So they're going to announce the quarter and they're going to announce the year. And I'm going to try to get to an earnings, like the financials. Written word is good, but for some reason, my brain works better with schedules and numbers. So let's get to the schedules and numbers. All right. So this is looking at net income. Okay, that's fine. And net income it went down from 23 to 24. Okay. I want to look at revenue. I want to look at the full income statement. That gives me the complete picture. That's why I want to look at it. Okay, so net premiums written, it went up 4%. Okay. So overall, consolidated, the premiums went up by 4%. Revenue went up by 4%. They did announce that they have calculated how much they're going to have to pay for the fires in California. And did I look at the quarterly here? Maybe. Let's take a look. So that's Q4. So they grew 4% Q4, but for the full year, it's even better. They grew by 8.7%. I like looking at top line revenue because it tells me if it's a healthy business. A healthy business is growing the number of customers they have. They're growing the products they sell. They're raising prices. They're doing it like Netflix as an example. They keep growing subscribers. They keep raising their fees. That combination is excellent. And they keep growing their top line revenue. Top line revenue, there's no substitute for it. That tells me a lot about the business. Profitability is good, but when you look at a P&L of a company, you see where there's a lot of, massaging of numbers. They can, reserve certain numbers. They can bring back certain expenses and so forth. So it's a little bit of an artificial number to look at net income. It's still a good number. Free cash flow is also a very solid number. It's very hard to manipulate free cash flow. You either had free cash flow or you didn't. All right. So these are very important metrics, but for the sake of this live stream, I am going to get to the meat of what I need out of my valuation. I'm going to come back and read this in its entire length and a little bit later. All right. So we got that. And are they going to give me a statement of cash flows? Let's see here. Will a statement of cash flows be provided? Okay, now we're getting somewhere. So here's the balance sheet. And these guys will carry a balance sheet. They got investments. That's what they do with the money when they get all these premiums. They get to earn some interest on those. Higher interest rates is not bad for an insurer. Liabilities, unpaid losses. These guys hire really smart mathematicians. These mathematicians, they calculate how much their liability is going to be. All right, that looks okay. All right, so we had good revenue. They were profitable. And net income did grow on a annual basis. In the quarter, it came down, but on an annual basis, it did expand. That's good to see. So their revenue expanded, and their profitability, the revenue and profitability expanded. All right, good. So we got that going. I'm going to open up another screen that you guys can't see so I can see some data, and then I'm going to update my valuation. That way you guys could see my valuation, and we'll go from there. So free cash flow for the trailing 12 months is a very good number. And so this is Chubb, and I value companies based on free cash flow and earnings per share, putting more weight on free cash flow, because that is, I think, the best valuation of a company is how much cash can they produce. Now, this number is not going to change for me. I don't have a statement of cash flows, and the trailing 12 months that I have is actually, it's a little higher than that. So this guy here, they're growing the revenue by more than 7%, which is good. I'm going to scale this back a little bit to 0.07, and I'm going to take trailing 12 months. So trailing 12 months is $15,169 billion. I'm going to multiply that times 1.07, which I'll add 7%. And then each year I'm going to add 7%. This is my forecast of cash. They really crank up the cash. That's why Warren Buffett loves insurance companies. He's a big investor in Geico. I believe they own the whole company. And now he's an investor in Chubb. For all I know, he's going to buy the whole company. He certainly has the cash to do so. He can buy it with one check. I'm sure he wouldn't pay with a check. He'd pay with some kind of escrow account. But you see that all this cash they're generating becomes this massive value, $326 billion of value. Adding cash and take away debt, we get to a massive equity. So this, just based on cash flows, severely discounted, 184%. Now, looking at earnings per share, when I look at that forecast, analysts think it's a buy, and it's discounted by 5.5%. Now, they're really giving them a low PE, which is incredible, right? These guys are going to do about $9.80. Am I reading that right? Am I looking at the right currency? Yeah, US dollars. Looks good. So earnings per share is $9.80. PE of 18. So forward PE. Analysts have some really low PEs on the stock, which I don't agree with. The earnings per share is expected to grow 17% for the current year. So I'm going to grow that by 10%. So I have a very discounted stock, in my opinion. It's a very good company. It has good pedigree. They produce just wildly high cash flow. And this is a stock that we went over on pretty much a live stream. It came up. I looked at it. And I'm like, man, that's a lot of cash flow. I'm already an Allstate stockholder, and I'm happy with Allstate. And insurance companies have been doing really well. So hey, you know what? There's no rule against me not owning two insurance companies, and I'm buying into Chubb. I bought shares today, and we'll continue to buy shares in Chubb. I think it's a really, really good company, and I think it's undervalued. I think this guy is going to deliver on with appreciation. And if we look at Chubb, one thing I look at is, okay, let's compare it to some of its peers. And Allstate's one of its peers that I'm very familiar with. So is Progressive as insurance, and Progressive's had a phenomenal year. And a couple of things that I would show is year to date, looks like Progressive's still number one. They're really kicking butt. Their stock continues to go up, but their valuation's a little tight. It's got a high PE, and they don't produce a lot of cash. But when we go to the 1 year, still Progressive is number one, Allstate's number two, Chubb is number three. And I think that Chubb could have a bounce back year and really appreciate toward where its peers are at. That's one of the things that I think may happen. Of course, investing is both art and science. The arithmetic, that's all science. Looking at metrics, you can say that's science. But the art is really using one's imagination that's rational. And my imagination is that, hey, this Chubb company is a good company. Insurance has been outperforming. I think Chubb's going to outperform because it is going to revert back to the median within its peer group. And right now, Progressive, I think, is priced a little high. My hat's off to Progressive stockholders, but I think the money's going to be made on Chubb. That's my opinion there. All right, so we just got through a valuation there on Chubb.